finance, a la shmup. What is arbitrage? Not your arbitrage, not my arbitrage, but arbitrage. What, it's been a while since we've conjugated anything around here. Oh, okay, so moving on. Arbitrage is a riskless trade. You make guaranteed profits just for being on top of things, or in the right place at the right time, or you're there when opportunity comes a-knockin'. Think about the stock exchanges in the pre-internet era around the world. Communication, it was relatively slow and expensive back then, especially when it came to sharing data. One relatively easy arbitrage or riskless trade opportunity that came about was when stocks traded at one price on the various European exchanges versus the prices it traded at on the US exchanges. Like, shares of IBM might have been offered for sale at $165.32 on the London Stock Exchange, even net of currency conversion prices. Remember, the Brits were on the pound system. But in the US, investors were paying $165.47 a share. So an easy 15 cents a share was made all day long in buying the shares of IBM in London and then just selling them back here in New York. Well, both sides of the trade were made at the same time. It was riskless. It was arbitrage. And arbitrage became a whole industry for a while until the capital markets went to work and spreads tightened as communication got more liquid and people sprayed a bunch of WD-40 on information passing around the world. And then that 15-cent spread from London to New York became more like a penny or a tenth of a penny, or at least close enough of a spread so that it was no longer worth bothering to try and make a buck, or a billion, or whatever those arbitrageurs made in those days.